Well, hi folks, and welcome to another Monday Marks Market Update. Today I'm going to talk about tax depreciation reports and how they balance the ledger when you have an investment property. So stick with me on that. Just wrapping up the week that's been with auctions. There were 81 properties that went to auction, and that clearance rate hit 77%, which is about the highest we've seen all year. So my assessment is that it's the low supply levels that we're finding of property, which is driving buyers to make purchasing decisions and buying both prior, at, and post auction. So good news for sellers. Looks like maybe things are really turning around and the things are balancing a little bit. So when you have an investment property, you have ingoings and outgoings. Now the ingoings, or the money coming in, is obviously the money from the tenant, but also tax depreciation reports. And that allows you to deduct items of the property that depreciate in value. When you combine that with the stamp duty deductions, they sit on this side of the ledger, and they help balance out the costs that go with owning a property, which are your loan repayments, your rates, your levies, if it's an investment property, maintenance or management fees. And so this is a timely reminder as we near the end of the financial year that you need to make sure you've got accurate tax depreciation reports. Companies like BMT do that in Canberra and get a lot of good business here. They tend to say on their website that they can find $10,000 a year in the first year of deduction. So it's quite a significant amount that will help balance that ledger out for you and make owning that investment property a lot more affordable. If it is negatively geared, well, it's going to mean that the property is just losing a little bit of money, and that is actually important to get tax back for you, so reduce your taxable income. A property can be neutrally geared, so the ingoings and outgoings are about the same, or it can be positively geared, so the ingoings actually make more money than what it costs to run that property from year to year. But just remember, if it does make money, actually get taxed on that income. So if you want to know a bit more about that, let us know and reach out. Otherwise, just a reminder, get your tax depreciation reports done as we near the end of the financial year for your investment property. And you also have just this month to exchange contracts on a property to be able to then claim your stamp duty in the current financial year. So if you are an investor you haven't bought, you're going to probably want to buy the next 4 weeks and exchange contracts. It's not about the settlement, it's just about the exchange, and that allows you to claim the deductions in a current financial year. Have a great week. See you next week.